The broadcast is now starting. All attendees are in listen-only mode.
Hi there, my name is Mark Sebastian, founder of OptionPit.com, and this is Trading Earnings with Options, the Option Pit method. I want to remind everybody that this is for educational purposes only. Shouldn't be considered investment advice. Options carry risk. For investment questions, seek an investment professional, not an educator such as myself. It is great to see everybody. So I want to remind people, most of you probably know who I am, but I want to remind you who I am if you don't. My name is Mark Salvo Sebastian I, and I am the founder of Option Pit. We are an education and consulting service. We work with, on our education side, we work with retail traders, and retail traders, high net worth individuals, you name it, and we teach them how to approach trading like a professional trader. How to think, address risk, you name it. We also have a consulting arm that works with hedge funds, asset managers, money managers, helping them do implementation and optimization. So basically, if you're looking to trade a retail account like a professional, this is about the only place you can go. So today we're going to talk about how options can be used to evaluate earnings, how to evaluate potential trades using options, smart directional earnings options trades, and a live look at earnings and a trading checklist. So I'll play around with some earnings for later in the week, and I'll give you my checklist. All right, earnings. Earnings are one of the wildest times a stock can have in a given quarter. Earnings generally represent a huge portion of a stock's volatility over the course of a year, especially if it's an older business like cars, phones, and trains. Things like biotechs and drug stocks and, things like that, a lot of their volatility is not earnings driven. Their volatility is more driven by development pipeline. A lot of Apple volatility, for instance, is driven by earnings, but also product launches. And you get the same out of a lot of computers and things like that. So, but for things like, CSX or Burlington Northern or General Motors or Comcast, earnings are it. So, volatility. What is volatility? I would say volatility, not a head, I would say volatility on the head. That hair is very volatile. But what is volatility? I've accused my wife of being volatile when she's really mad. Then her arms hit me with a lot of volatility. No, I'm kidding. My wife is the best. But, the short answer on volatility is movement, especially for what we're going to cover. Volatility is how much a stock, or anything for that matter, is moving for a given time period. Volatility is movement over a time series or over a data set. All right. Stocks that move around a lot are volatile. Stocks that are slow moving are not volatile. Pretty simple, right? Yeah, I see that. It's volatile, not volatile. It's a good thing. So there are two measures of volatility I want to look at. That's historical volatility, which we'll call HVOL, and implied volatility, which we'll call IVOL. HVOL and IVOL. So let's start with HVOL. What you are looking at is two charts. All right. This yellow line, it's actually three charts. This yellow line is the stock price of Facebook. All right. This red line is one measure of HVOL, historical volatility, and that is ATR, average true range. You can use average true range, you can use close to close, intraday, overnight volatility. I like ATR a lot. I like close a lot. And what I want you to pay attention to is the red, and this gets a little confusing. The red, the ATR is associated with the numbers on the left, and the yellow is associated with the numbers on the right, and then down here is the volume. So right now, the average true range of Facebook is about 20. All right. So ATR stands for average true range. That's basically how much a measure. It kind of tries to take the so most historical volatility charts look at comparing the closing price to the next day's closing price or the previous day's closing price. But what that leaves off is, for those of you that look at candles, let me pull up TradeHawk here. Stock chart. So let's look at a candle chart of Facebook. Get in there. There you go. So what I want you to notice, I'll just go to 1 month. What I want you to notice is that, look at this little candle here, right? This guy right here. While it might, the previous day Facebook closed, come on, 218.08. The range here today, the open was 218, the high was 218.23. So the range was over $1, but the close is only 20 cents away. So what ATR tries to do is take into account intraday movement along with the closing price. ATR is a million times better than close-to-close volatility. So while I look at close-to-close, I have a lot of trouble. I like to know the whole story. So I like to know, okay, if I just traded and then closed my eyes, how much volatility is there? That's what close-to-close volatility gives me. I like to know how hard it is to hang on as days pass. Yeah. So with ATR, I'm getting that intraday movement. So ATR, my ATR here is about 20, average true range. That's nice. All right, that's got some movement. You can see how high it can get. So that's telling me something. That's telling me what's happened in the past. It's telling me, hey, here's what ATR has been. Not, then. So historical volatility tells us what's happened in the past. This is a 14-day ATR. So I look at the last 14 trading days. All right, then we have something called implied volatility. All right, this red line represents Facebook implied volatility. And this is from an hour and a half ago. And it's 30-day IV. So it's telling me how much is the market expecting Facebook to move for the next 30 days. It's the market's best guess of what is going to happen in the future. Pretty special, right? So implied volatility is the market's best guess of what will happen. But where do we get the market's best guess of what will happen? Where do you think we get that? All right, well, let's think. Implied volatility, that number comes from options pricing. You know, the VIX, the volatility index, is derived from options pricing. This means that an options price is the market's best guess on how much a stock might move in the future. All right, so that's huge. Not what I was looking to do. That is huge. So, this is why options are so important for figuring out earnings. All right. It's the key. They're telling us what's going on. So, this is where the straddle comes in. The long straddle. All right. A straddle is a long call and a long put on the same strike in the same month combination. And it ends up kind of looking like this at expiration. Pretty simple. All right. So an at-the-money straddle, because it does not care about direction, only movement, is the market's best guess at how much a stock might move on earnings using weekly options. Let's take a look at Facebook, which is reporting today, and in fact already did report. So Facebook, you can see, is trading right at 217.5, 217.33. The 217.5 calls are 590. Use that yellow number. The puts are 610. So we get a nice round number of 12. The Facebook at the money straddle, this expires on Friday, is $12. That is relatively close to a 50-50. All right. That is pretty much close to a 50-50 coin flip on how much it might move. Technically, Facebook should move less than $12 about 58% of the time. But that's pretty close to 50-50. Sell it. And we're going to talk about that. So there's your straddle. So if I wanted to look at a Facebook straddle, I can use that to calculate the percentage move. All right. So the Facebook straddle is $12. Facebook's 217.5. How big a move is the market expecting? About 5.5%. 12 divided by 217.5. Really simple. We're looking for a 5.5% move. All right, now let's do the next step of evaluating. And this maybe can tell us something. So is $12 5.5% low or high? Is 5.5% low or high? Well, you have to do your research. All right, well, today, someone said, yeah, it's low today. Yeah, it is low today, but is 5.5% low historically? Because if it's normally priced about 5.5%, then maybe it's perfect. If it's never that cheap, if 5.5% is the lowest ever, maybe that's telling you something. All right. If it's sky high, that's also telling you something. So here's another look at Facebook iVol on TradeHawk. And what it's telling me is there are some spots at the money-ish right here. Vol's pretty flat. Calls on the upside are crazy cheap. And downside puts are also really expensive. Pretty cut and dry, right? I love looking at this chart. This tells me a lot. This red line is a smooth curve. It's kind of like the if I was going to run a saber model on what I'm looking at. The green dots are the strike prices. This is a volatility and skew chart. I like this So there you have it, folks. This is a really good view. You know, when I use a combo of TradeHawk. Let me share that vol workshop and LiveVol. So here's Facebook. I'll pull it up again, and I'm looking at July options. I want to set to curve, set to implied, and this is obviously showing you some screwiness. I'll pull in a smoother curve. We had some funky end of day stuff that I think is messing with the strikes. But if I just go to set to curve, and then I'm going to unshow values, this is a smooth curve of what volatility looks like. So what you're looking at is different strike prices on the bottom and implied volatility on the left. Kind of neat, right? It's really neat to look throughout the day and see kind of exactly where each strike price is priced against others. You can find things to buy and sell. So for instance, earlier someone said, well, I sold the 205 put and bought the 195 put. I would have argued that that is possibly the worst trade that you could have set up. You sold the cheapest option on the board and bought one of the more expensive options on the board. Sorry, don't mean to use you as an example, but I didn't call out who you are. I would have actually set it up the opposite way. I would have bought the 205s, sold, and I'll tell you what I would have done here, actually. This is a really good view. So now, let's talk about how I might set things up. All right, in the case above, we can see that upside is dirt cheap, at the money is flat across several steps, and downside is bid heavily. Huge. What does that tell us? What does that tell us when we're evaluating Facebook reporting earnings? What does that tell you that that everybody's selling calls and everybody's buying puts? They're putting on the collar, the risk collar, as it's called. Yeah, I never do that, Ed. Yeah, so there's a lot of people collaring their positions. When you see an exorbitant amount of collaring ahead of earnings. That is very, very, very bad. All right. Kind of interesting, right? So, let's talk about non-directional trading. Generally, don't do it. It is a loser. All right, I will give you the scenarios where you will do it. All right, but generally speaking, don't trade non-directionally around earnings. All right, you guys know who my friend Russell Rhodes is, of SIBO and Future Tab Group fame. So he ran a study on earnings. All right, he ran a study on earnings, straddles, buying and selling straddles on every earnings for like 10 years. And you know what he found? Selling straddles lost, and guess what? Buying straddles lost. Get that straight. Selling and buying premium both lost. You know how they lost? Bid-ask spread. That is it. So what happens is short premium wins more often but loses huge when it does, a la Facebook today. And vice versa for long premium. It loses more often, but when it wins big. So here's what I will say. If you do your homework, if you do a lot of homework, and you figure out, hey, this earnings is way, way, way too cheap. The premium is too cheap. It is never this cheap. Then, and only then, will I say, hey, maybe think about doing an at-the-money straddle versus an buying versus selling an out-of-the-money strangle. Or what's known as a long iron butterfly. Long a straddle, and then short wings. And here's the problem. You're going to say, well, what about the opposite? What about when earnings are a crazy bid? Guess what? Typically, they're crazy bid for a reason. Sometimes you'll see the market get overly complacent on cheap vol. Expensive vol is usually expensive for a reason. Everyone write that down. I'm going to write that down right here. All right? This is going to be a big rule that I just decided to write down. All right? Expensive volatility is expensive for a reason. Cheap volatility, not always so. So it's kind of like, expensive volatility is expensive for a reason. Cheap volatility, if it's really cheap, it might not be cheap for a reason. All right, so directional trading. You want the truth? You can't handle the truth. Well, I'm going to tell you, I almost never trade earnings. I trade in front of them. I trade behind them. So tomorrow, I'm going to trade Facebook. All right. Tomorrow, I'm going to trade Facebook. Yesterday, I would have traded Facebook. But every now and again, I do take positions, especially in some loved names like, you know, I'll play a direction or two. So only set up an earnings trade if you have an extremely strong conviction. All right? There has to be a story to what you're doing. So I only go directionally if I really have a reason. Facebook had such a crazy strong run. If Facebook was still $200 and not $217.5 today, I would have set up a bull play. But that run it had into this earnings, way too crazy. So the story already got priced in. The story is Facebook is a killer company. All right. So if Facebook was still $200 like it was a couple of weeks ago, all right, then I probably would have set something up because I would have said this is going higher. But since it had that big run, I'm not interested. So tomorrow morning or tomorrow afternoon, sometime during the day, I am going to do a trade. So Virginia says, it seems to me when earnings plays are gambling and fraught with obstacles, better trade the reaction. Yes, but some people are addicted to excitement. Yes, but I'm going to show you how to properly deal with the excitement, how to set up a smart trade. If you have a real good reason to pick a direction, here's how to do it with the best odds of success. And the answer is the butterfly, the 1-2-1 spread. As you know, a bull butterfly or a bear butterfly is a long call or put close to the money, short 2 calls or puts further away, and long a call or put even further away. I think Facebook is going to move higher. Here's the checklist to build my trade. Now, I just threw this together. Calculate the straddle price. Calculate the curve. Evaluate the curve. So first, calculate straddle price. 2, evaluate the curve. Then pick a direction. If I'd have been thinking, I might have set it up bear. But I was just kind of throwing this together so you can see an example. Now, here is the key to setting up butterflies. Set your first leg within the straddle. Within the straddle price. Then set your 2 shorts outside of the straddle price. And then set the longs equidistant from the short. And then finally, consider a hedge. So let's look. Facebook is 217. The straddle is 12. So I would buy either the 225 or the 227.5. So upside is cheap. So I buy the cheap, sell the cheaper, buy even the cheaper. This is what this looks like. This is a 5-lot straddle. The 225, 235, 245 call fly for $1.49. So I'm putting on. I'm trying to collect 850, 851 versus $1.49. So that's a 851 divided by 149. I'm getting a return about almost 6 to 1. And I would be setting this up right before earnings. This was done this afternoon. And yes, same week. If you're going to play earnings, play earnings. All right. So this is from today. This is a call fly. All right. I'm long the 225, short the 235s, long the 245s. And you can see these are my different days. This is July 25th, my mom's birthday. Here's the 26th. Here's the 27th. And over here it tells me how I can make money and on what days. So this is on the 28th, and here is today. So you can see I'm betting 770 to make a lot. So now, if I was going to set this up as a hedge, what I could do, going to my what if, I could actually add a what if position. And then I'm going to look at my WISP. This is from today. And I'm going to maybe find like a cheapy put to hedge. So you can see I produce a decent delta on this trade. So maybe I'll buy I'll buy a put, and I'll buy like the 205. The 205 put, which is right outside the straddle, is $1.59. So I can buy a put. And you see, here's my positions. Now here's what I look like. It's a good way of hedging off tankage risk. That would have been something I would have done if I was really thinking about doing this trade. I was not. So when earnings come out today, IV will collapse. So if let's say it moves $12 up. At $12 up, my 225s will be worth about $5. My 235s will be worth a quarter, and my 245s will be worthless. It's just what is WISP? That is my vol matrix. The trading platform is TradeHawk. I like TradeHawk because it's all you can trade for $149 a month through OptionPit. But you have to be a client. So that's what I would do. Go me. All right, a better way. So let's talk about a better way. Trade before and after earnings, not during. Typically, IV gets oversold and the move is too dramatic. The mean reversion trade. The move is too big. The IV move is, and implied volatility gets oversold sometimes. Wait a day and then trade in the other direction unless. Here's how you know whether to trade with the trend, especially on a bearish move. One second, people. If a stock tanks and the implied volatility is completely crushed at the same time, to the point of being near recent lows or year lows, what is that telling the trader? What is that telling you? The trader. No, what that means is traders are selling the stock instead of hedging. If everybody's selling the stock instead of hedging, that is a bad sign. That means the stock is going to keep going lower. That is the most bearish trade I see. Stock getting killed and no uptick in implied volatility. That is bad news. Fade it. Don't fade the move. Go with the move. So in summary, options can tell us a lot. Don't play non-directionally. Directional plays must have a story and use flies to your advantage. Now let's look at some trades, but before that I want to give you my little pitch. This Sunday, July 29th, from 9:30 to 1:30 Eastern Time, we're doing Repairing Terrible Trades. It's going to be a 3 to 4 hour class. Yeah. From 3 different instructors, myself, Andrew Giovinazzi, and Keith Harwood. All right. Are each going to talk about repairing terrible trades. Andrew's going to talk about repairing certain types of trades, calendars, things like that. I'm going to discuss repairing terrible trades, things like butterflies and credit spreads. Keith is going to talk about repairing directional trades. You're going to learn how to fix all the losers, and really, I think the most important piece is you're going to learn how to fix when not to fix a trade. Shrink my head. There you go. You're going to go optionpitmembers.com/fix. Yeah, the directional stuff. So when not to touch something. That'll probably be me. You know, a lot of people treat their trades like a... Yep. So it is very confusing. Where is the literature for beginners who know basics but looking to advance? This will actually be a good, because everything we do builds as a crescendo. And oh yeah. Yeah, again, I'm not an English major. So, we build the way we teach it in crescendo. So it starts off easier and gets progressively harder. And so you'll be able to get through it. And then I'll tell you, if you take the class and it was too much for you, I will give you something else to push you through it. Or better yet, give me a call or shoot me an email, and you and I can talk on the phone, and we'll figure out how to get what you need. I don't want to sell you something you don't need. I have a real problem with that. So you're going to go to optionpitmembers.com/fix. And now here's the best part. When we sell this as a recording, it's going to be $297. I'm going to let you use a discount code, 25_off, all caps, and you'll take an extra $25 off. This is a really good course. I think the most important part is learning when to touch and when to leave a trade alone. That is key. You know, most people treat their trades You know, a trade is like, you know, once you touch it, you can't take it back. All right, and that's the key. So leave it alone. All right, then Andrew's going to do some non-directional stuff. I'm going to do some non-directional stuff, and then the directional stuff, Keith's going to walk through directional, and it will be recorded. You have access to it. It's yours for life once you buy it. All right, it is going to be pretty freaking awesome. So I want you all to do that. Now, with that, I want everybody to go. I will evaluate one earnings play for you guys. I will tell you what I think in terms of what the market is telling us. And then I will put a trade together. I'm not doing Amazon. I have a personal vendetta against Tesla, so I can't do Tesla. I do like that. How do you know it should go long after Facebook earnings? I'm going to do AMD. I like that one. All right, so let's look at Facebook. So I'm going to have to use a little bit of live vol. I am migrating all of my trading off of Sterling Trader. I'm getting a real live vol pro that I'm going to be using. And then I'm going to only use TradeHawk for my actual trading. It's just too good a platform. So Facebook is down 20. All right. Now to start, I'm not going to trade in the July month. I'd be trading in the August. So here's what's important to me. I want to see where the volatility goes. So I'm looking for, with it tanking like this, I want volatility to be kind of here-ish. I want it to be above around 24 when it opens tomorrow. Between 24 and 27. Kind of this range. If that is the case, then I will probably set up a reversal butterfly. So what I would set up, there's my vol workshop. What I would set up, I'm going to get rid of these. Let me get my WISP up so I have pricing. Where is WISP? Can I pull up a new one? So I'm going to set my short strike about where Facebook was today at 220, around 220. So, and I'm just going to throw in some pricing. So my first strike would probably be around 200 or 210, maybe 205. And all right, the 205s have 20 cents of Vega. And I expect volatility to be in, this is where I still need live vol. I would expect volatility to be in 205s. I'd expect volatility to be 10 points. So these will be worth about $6. Then at, let's say, 217, the AUG 217s, these will be worth about $1.50. And then I'm going to make the, we would do the 235s for the final. And I'd make that price probably, I'm just going to make it a dime, or a nickel. I bought. Come on. Get in there. Now we're done. Come on, get in there. Anyway, you get the point. So anyway, I will end up paying $3 for that butterfly. And I like that. As a turnaround, I'd probably hedge it with a put. That is how I would do that. So now, let's look at AMD. When are their earnings? AMD is not boring. It's been a flyer. Are you kidding me? Oh. Well, that's not interesting. I'm not going to do AMD then. Spot. My girl Smasty. The smastiest girl around. What does Spot report? That Spot Hero? Let's look at the vol and Spot. Wow, that's ugly. Their conference call must be awful. Oh, they're tomorrow. And that's Spotify. Well, what's interesting is, look, the vol's actually trailing off as it's coming together. Jeez. But the near data vol is super expensive. Holy bananas. How much did it move on its last earnings? Oh, it doesn't have last earnings. We have no idea. Stay away from Spotify. Do not trade that one. All right, I'm going to pick one if you guys don't. How about Exxon? They have earnings on Friday. They're looking for a $1.70 move. Let's see what that looks like. $1.70 divided by 83.5. A 2% move. This one will make some real moves. I mean, it's had a couple of snoozers. This is not one to sleep on, folks. Historically, I mean, the vol's not cheap. It's about where it was the last time. This sucker could move. All right, so let's take a look at that curve now in ExxonMobil. Well, you can see I'm going to hedge at the 87. I'm going to sell. I mean, they're begging you to buy the 86 calls. And actually the 85.5. And even the 85s are kind of cheap. I would do the 85, 86.5. Yeah, that's not bad. So in Exxon, the 85 calls are only 34 cents. I sell the 86s at 13. Or the 85.5s. I mean, the 84, all right, here's what I do. The 84s are 43 cents. Or the 84.5s. What did I say I wanted to do? The 80. Look at that again. Yeah, I want those 85s. I'm going to buy the 85s for 35 cents. I'm going to sell the 86.5s at a dime twice. So that's 15 cents. And I'll buy the 88s for 4. 19 cents for a $1.50 fly. That's a nice price. That's great risk reward. I would be willing to do that one. So there you have it, folks. Any questions? Now that we're done? All right.